Welcome back everyone. In this video we will cover one of the most popular strategies, the short straddle. A video has already been made on the opposite figure, the long straddle, and I recommend that you look at it again because it is useful to better understand the importance of risk profiles. Both are part of the so-called delta neutral strategies. Let's see how to open a short straddle position. First of all, a short straddle is a strategy composed of the combined sale of call and put at equal strikes, ATM, and in the same quantities. For example, if the underlying price beats 1,000, we sell the same put and call options at strike 1,000. Let's look at the dark line, which represents our payoff at expiration date. If we trade this position, we have a market expectation in which the prices move sideways. We do not expect a directional movement in prices. In fact, what matters to us is that the market moves slowly and in a shallow way, without directionality. In this case, we collect 80 points from the sale of the two options. These dollars will set the break-even points at 1080 on the call side and 920 on the put side, leaving the price with freedom of movement of 160 points within this range. The position will start to lose if the underlying price stays beyond the break-even points at expiration. Let's do the math. $80 out of $1,000 are 8% upwards and 8% downwards. This means that in 40 days the underlying will have to move by more than 8% and continue in the direction of the trend to challenge the position. Statistically, this is not a situation that often happens. This explains why this strategy, together with the short strangle, is among the most used and known by optionists around the world. However, I want to underline that credit strategies, such as the short straddle, hide important pitfalls and are never advisable, especially for those who have just approached the derivatives market. The risks related to holding uncovered portfolios are particularly high, especially if the naked options are both upside and downside at the same time, as in this case. Remember, the market can do three things: go up, go down, or stay still. In this case, we bet only on one of the three probabilities. Stay still. I want to warn you. Very often the lack of knowledge of the instruments, the low capitalization, the unforeseen events have put an end to the trading ambitions of many operators, attracted by the rich premium that was displayed only by the payoff at expiration date. Let's focus on the orange curve, which is our at-now line. In contrast to the long straddle figure, in the short straddle we have the time decay in our favor. In fact, the dark curve is above the at-now curve. If the underlying price stands still, the price of the options tomorrow will be lower, and slowly the curve will approach the dark line, bringing us a profit every day. 10 days after the deadline, the orange curve will look like this, and the options will be worth $20 each. Since we sold them for $40, we can buy them back for $20, thus generating a total profit of $20 plus $20, $40. But it's not just a question of time value. Let's go a step further and introduce a very important variable. There is also another important component that affects the price of options in general. This variable is the volatility, or the speed of the market movements in a given period of time. The price of options is affected by volatility. The higher the volatility, the higher the option price. The call and put 1,000 have a premium of $40 each at 40 days from expiration, only if the volatility is 30%. Well, allow me a strong, but still plausible hypothesis. If today the volatility from 30% collapses to 15%, the price of the options goes from $40 to $20, and also in this case, we would book a profit of $20 plus $20, $40. A decrease in volatility, therefore, is an important benefit for credit strategies and is equivalent to moving the clock forward in time. Let's recap. At ATM, with the same volatility, if 30 days out of 40 pass, the price of the option is halved. On the other hand, with the same time to expiration, if the volatility is halved, the option price is halved. The opposite is also true. If the volatility doubles, the price of the options doubles, and the at-now curve falls below zero, and the position is temporarily against us. We will explore these concepts even better in the next videos. Let's see, in this slide, how we can protect the position. To hedge the options sold, we can buy by paying money to the market, a put at strike 900 and a call at strike 1100 by spending $21, respectively $8 for the call and $13 for the put. In this way we lower the maximum gain on the cusp from $80 to $59, but we fix a clear mat at the maximum loss, which becomes $41, while maintaining the same structure as a short straddle, but with a slightly narrower cone. This particular figure, born from a short straddle, is called butterfly. Thank you very much for watching. See you in the next video.